afternoon. Welcome back to KCAA Radio. My name is Dan Redig. I'm here with Chi Nguyen talking about note trading. Fascinating background. Thank you so much for sharing on that first segment. I think at this point, everybody's dying to know, though, how does this work? How do you actually acquire notes? How do you trade notes? What's the basics?
Yeah, good question. I guess I can kind of really mostly speak to how I got started in it, which
Okay.
is if you want to purchase notes, the way that I did it was I just went to a bunch of events and got to meet people in person. For me, I'm a very big in-person advocate because people can feel your energy. They can know if you're genuine, if you're, if that you don't have any tricks up your sleeve, that you would close
Hmm.
on time, that there's somebody that they would like, that you're somebody they would like to work with. And so I guess I would start off buying like what we call as onesie twosies in the industry, like buy one or two. My biggest piece of advice in purchasing your first, few assets in the note investing world is to probably purchase a few like at one time. I started purchasing second position non-performing notes instead of first position. And they like to
Okay.
say in the second position world that you want to purchase at least 4 to 5 in your first one, in your first purchase. So it's
Okay.
called a little pool, is what we
Hmm.
call it, a pool of
Could you
assets.
explain to people what that means when you're purchasing second position notes?
Sure. Yeah. So I'll give an example with numbers because it
Okay.
helps. So let's say you're purchasing let's say a borrower, okay? A borrower, like a normal homeowner, goes
Uh-huh.
out and tries to buy a $500,000 property here in San Diego, which I know existed a while ago, but let's just say
It's been a minute.
yeah, a perfect world. Let's say it costs a $500,000 and let's say it's a normal transaction. They put 20%
Hmm.
down. So they put $100,000 down and they got a 80% loan. So they got a loan from the bank, let's say Wells Fargo, for $400,000. Let's say a few years goes by and their property appreciates up to $800,000. And they decide to take some of that equity out to buy, I don't know, a yacht or pay for their daughter's college tuition or, you know, buy their son, I don't know, whatever it is. They tapped into the equity of their home and maybe took out a HELOC or a second mortgage. A HELOC stands for home equity line of credit in case anybody out there.
Okay.
But
Good tip.
so if you're buying a second position note, let's say that person, let's say his name is Joe, he a few years down the line decides to stop paying on his second position mortgage for whatever reason. Maybe he lost his job or he ran into some medical issues, or maybe he's going through a divorce.
Hmm.
Um, he stops paying it, or maybe he thinks that, his second position note doesn't matter as much as his first position note, or that the
Oh,
payments have been rolled into it. That's actually very common back in the 80/20 days in 2008, that people think that their second position note was rolled into their first position note. And so they only had to make one payment.
oh
There's a
boy.
lot of confusion around that. But anyway, so let's say he stops paying on the second position note he also maybe doesn't think that the second position note has as much power as the first position note to foreclose on him, which is not the case. Just because I
Hmm.
because I hold a second position note, if I have full equity coverage, so let's say that he on his second position note, he only took out $100,000. So really he has less than $500,000 in debt on an $800,000 property now, right? So he has
Hmm.
$300,000 of equity. So if I were to foreclose on his property, I have full equity coverage. And even if it goes all the way to foreclosure sale and then an investor shows up and buys it for 60 cents on the dollar, I would still be mostly covered because of the ARV that would be maybe 950 or something
Uh-huh.
after they're
Okay.
done with it. So does that make sense? I know that was a lot.
Yeah. And so the second position is just the second lien on the property. Is
Yes.
that the best way to explain it? Okay.
Yeah.
Okay, great. So you got started with second positions.
Yes. That was
All
way
right.
shorter than my long
No,
explanation.
no, but talking about the mechanics of it, that's great.
Okay.
People will get a lot of help from understanding it. So you got so you were buying onesie twosies when you started, and you
Yeah,
recommend buying a pool.
I recommend buying a small pool, especially in the
Okay.
second position mortgage space, because they often turn out all sorts of ways. So I think I bought 4 or 5 in my first go at it, and it's so true. They actually say that you're probably gonna get one note that does, gets into bankruptcy, one note that reinstates, which means they start paying again and they get fully current on their loan and they're making payments as normal, and
Uh-huh.
one note that maybe goes through foreclosure, or one note that fully pays off for whatever reason. Maybe they had funds, they could pay it off, or they could, maybe they sold the house or something like that. And I had all 4 of those situations happen in my first little purchase.
Oh, wow.
Yeah.
So you
So
live the statistics live.
yeah, it's really crazy. Like I'm telling you, it's like, I don't know, some sort of like divine intervention. But it was really great because I got experience in every single one of those
Mhm.
possible outcomes, but also because well, thankfully each one of those notes were very profitable for me. But people like to say in the industry that you should buy a small handful when you first start out if you're in the second
Mhm.
position, because one win on a second position can fully cover a loss on another one.
I got it. Okay.
Yeah. Hmm.
So you need to have enough in the business to make the business work, basically.
Yeah, but also that, you buy all those notes at a steep enough discount that you're going to make a great return on a win. Um,
Hmm.
But another one, you might find out that it's completely unsecured because maybe you didn't do your due diligence enough and there was
Uh-huh.
another lien that got placed on the property ahead of the first and second position if you're in a super lien state, or if they have tax liens or something like
I
that.
see. You got to know where you are in line.
Hmm.
Hmm.
Exactly.
So I'm sure folks out there listening are dying to know, how do you buy these at a discount? Like, banks usually hold these. This is not typically, folks aren't getting loans from an individual who's going to have a note then to trade you. So how are folks, getting their hands on these? How do they become available?
So I like to call it the life cycle of a note. So let's say that Wells Fargo originated the note, okay? And
Hmm.
they collected payments on it for somewhere between 6 to 12 months. So they got some seasoning on it. And they
Okay.
decided to then sell it to Bank of America because they made most of their money on the origination. And
Hmm.
they really like to get their money turning and churning because the velocity
Right. Yeah. Velocity of money. Yep.
is, yeah, where they make their money as banks. So they'll sell it to Bank of America. Bank of America will do the same. They'll buy it for a little bit of a discount, but they'll get a few payments and then sell it again
Hmm.
to maybe, let's say, Goldman Sachs. And then Goldman Sachs would sell it to an investment fund like the one maybe I'm running now, or something like that. And then the
Okay.
investment funds will sell it to onesie, twosie, smaller mom and pop investors. And so you just kind of have to get connected with like the right brokers, and just honestly, go to a lot of the events in the industry so people end up knowing who you are and wanting to do
Hmm.
business with you.
Okay. So you go there, you are literally going to be able to find a broker, maybe for Wells Fargo or similar, who's going to be selling notes. And it's
Yes, we try to
okay.
go at the investment level higher, up the
Hmm.
food chain because we could buy in bulk, and when you can buy
Sure.
in bulk, you'll get a better discount.
Makes sense. So for anyone listening today who thought they were going to give this a try, they could basically go find a broker though at a meetup somewhere who's
Mhm.
directly connected to a bank.
Yes. Not all of the brokers will be directly connected to banks. They'll probably mostly be connected to funds like mine.
Uh-huh.
But that still gives that onesie twosie mom and pop or just starting out investor access to notes that they can purchase.
Okay. So it's actually readily accessible. And it's kind of, I guess, what
Yeah.
I'm trying to help people understand is that they
Yeah.
can go do this if they had enough money to buy just one, they could go do that next week, quite literally.
Yeah. Yep.
All right.
Exactly. They just can get set on a buyer's list.
Got it. So if you're going to buy a pool, let's say I'm going to go out and buy just a pool of 5. It's my first go. Uh, what kind of capital would you suggest I need, and what's the general due diligence process?
Oh man, those are big questions. So
They are.
well, the general amount of capital you would need totally depends on the pool. So,
Hmm.
I mean, if we're talking second position mortgages, just because you're talking about second position mortgages doesn't mean it's a much smaller amount. Um, it can generally be a lot smaller than the first, but I've seen some
Hmm.
second position mortgages that are in the hundreds of thousands,
Oh
and I've
wow.
seen some
Okay.
first position mortgages that are or like around the $50,000 range or the $20,000 range. So you just have to kind of calculate not calculate, but determine, I guess, what portion, what segment of the market you want to be in, right? Like it's like a flipper wanting to figure out whether or not he wants to be in the starter home section or in the luxury flip section of the market.
Right. Or even what part of town.
Yeah, exactly. So there's no real hard and fast answer for that. It just depends on what your style is and what kind of collateral you're looking for.
I see. All right. So then the first couple steps of due diligence, because we're going to have another commercial break here in about a minute. But
Sure.
how does someone get started with that?
Yeah, yep, like I said, it's another good question. Due diligence, obviously you want to, do you mean the first or the second position? Because it's very,
Let's stick to the second position for now.
okay, great. So the second position, due diligence is, I guess you would first look at the background of the senior lien status, know if it's whether
Mm-hmm.
you figure out whether or not the senior lien is performing. That's a huge one. And then what your CLTV is, what your combined loan to value ratio is. Do you
I
have full
see.
equity coverage or not?
Mm-hmm.
That would affect my bid quite a bit. Then I would do a lot of research on the borrower, check out whether or not the borrower has ever filed bankruptcy, see what type of record they have in terms of criminal
Mm-hmm.
and pay history, if they have any criminal history, then the enforceability of the note.
I see. All right. We'll pick that up on the flip side here. We're going to take a quick commercial break. So we'll see you guys back here on KCAA Radio after these messages. Thanks for listening.